and welcome to this edition of Closing Trades. And what a turnaround from where we were same time yesterday. It started off a gap up and we've nicely managed to cling on to the gains, if not build on further. So as we speak right now, it's a good 2% move that you're seeing on the index. It's a 450 point uptick, 22,720 is where we're currently sitting at. I mean, to be fair, the rebound is not for just us alone. The rest of the world markets as well have seen a rebound. It seems like there are some negotiations with tariffs on the table with the US administration, and thereby the markets feel that there is some scope for perhaps evading a tariff war. Having said that, the status quo with China clearly continues. It's really been, China versus US with every statement that's coming out on the tariffs. So as we speak right now, Japan managed to close in with a 6% gain. Australia held out 2.5%. There was Hong Kong, which has also seen a gain of about 300 points on close. And Shanghai as well leapt up very nicely, about a good 1.5% in trade. The European markets too have started off on a good amount of green. So across the board, you are seeing over 1% gains coming in, with the FTSE taking the lead with a 135-point gain. The pre-market rates in the US, the US futures, they too are staging a comeback and a rebound. So that's also looking good. So far, so good. It's a global market rebound that you're seeing, but how long lasting is it going to be? Right now, of course, Cheryl, you are seeing pretty much all sectors in the green.
Absolutely, actually, Aisha, not just all the sectors in the green, all the Nifty constituents also are in the positive territory as we speak. If you look at some of the counters that are in focus, Interglobe Aviation, take a look at that stock, what it's doing in trade today, because brokerages have forecasted a strong Q4 number. So you have Interglobe Aviation trading higher by about 3.8%. Apart from that, you have Bajaj Finance, you have CLSA that's reiterated the stock as their top pick. So take a look at Bajaj Finance in trade today. Shobha Realty, Godrej Properties, both of them reacting to their Q4 operational performance. Along with that, add to the list Titan as well, seeing a good jump in trade today. So yes, you have a lot of green on the screen and no one's complaining for sure. We have Kunal Bothra as well as Sunil Subramaniam joining us on the show. Good afternoon to both of you. And Kunal, first up, markets. You think we should rejoice too early, is it, do you think?
I've not seen such kind of a, interesting chart pattern. Yesterday we were almost at a 700-point gap on the index. So, after that, sharp drop from 22,900 thereabouts towards 22,200 where we closed yesterday. And we've almost filled 3/4 of that gap. So, that 700-point gap, we've closed at, we are almost at 22,700 mark. So, we've almost closed that, 700-point gap, by a margin of 500 points. And, that's happening on the immediate next day. And that's a very rare kind of a movement for, the index. Interestingly, I think today's move is led by across the board sectors. We were discussing this in the morning that there could be a bout of short covering which could probably come back into the indices, and specifically for the underperforming sectors. Now, that's the first day of the market move. Yes, we've seen a global relief rally also aiding the market move today. Whether we see a follow-through up move over the next couple of days, that will be something which is going to be interesting. Tomorrow is also the weekly expiry. So I think that would probably be one of the reasons why maybe the markets could be a tad bit more volatile. But as of now, I would believe that traders could look out for maybe 22,900, which is the low of the couple of days back of trading session. That could be an immediate target for the index.
Okay, let's welcome on board Sunil Subramaniam as well. Sunil, hi, good afternoon. Good to have you on the show. A rebound, yes, today, but do you think it's only flattering to deceive, considering there aren't any conclusive negotiations, at least with China, when it comes to tariffs with the US?
So I would actually look at it differently. I think that yesterday's opening correction was overdone as far as India was concerned. Yes, the tariff implications were there for India too, but relatively we were always in a better position. Second, we are not an antagonistic country. We are not saying counter tariffs. We are actually negotiating a bilateral trade agreement. So when the market opened yesterday deeply down, I think the recovery has started from there. You see the second half of yesterday's market and today's continuity. And the reason for that is that increasingly it's being felt that India is not going to get harmed relative to others, number one. Number two, we have plenty of cash sitting on the DII books, whether it's insurance companies, asset management companies, portfolio managers, or the lot. And they are looking for price corrections to go and buy good quality stocks. Now, yes, the earnings season will give us the ultimate in terms of who is going to be a better outlook sector to do that. But given the depth of the correction at the start yesterday, it made a lot of counters for DIIs seem attractive. So I think as this buying process started midway yesterday and is continuing today. The second factor which is driving this as far as India is concerned is, of course, the RBI policy tomorrow and the strong expectations that there will be at least a 25 basis points rate cut, definitely some liquidity infusion, and a small proportion of the market is hoping for a 50 bips if that comes. So that's why you see interest rate sensitive sectors are actually also going up today. So I think that to some extent, I would say that the impact on India, right, I think was overdone, and market is realizing that today we will face certain sectors, we will definitely face the heat of tariffs, but there'll be certain other wins too. So overall, on a balanced approach, and I think information is coming out from government officials that despite the tariff scenario, because of the weakening price of oil, right, I don't think our GDP projections are going to be way off the mark for 25-26 of the 6.5. Maybe a 6.4 to 6.6 range. So I think all of this means that India is not going to get unduly impacted badly. On the contrary, given the ongoing negotiations with America, maybe in 6 months' time, there could be a bilateral trade agreement dotted and signed, which means that we would be out of this whole tariff bracket. Because once you have a BTA, a bilateral trade agreement between us, then I don't think that the tariff scenario applies. So I think, yes, but doesn't mean that all sectors are going to gain and all of that. You've got to be still careful. But I would say that the depth of the correction yesterday is probably not going to get repeated. There will be volatile days when some bad news comes about the tariffs. There will be volatility, no doubt about that. But I think that there's enough firepower with domestic fund managers that quality stocks are going to get picked when they correct.
Today you had the DII buy figure in excess of 12,000 crore rupees, believe it or not. But Sunil, what should be one's sectoral bias, and what are the sectors you would say completely avoid because of perhaps the global linkages?
So I would say this: if you do a Venn diagram, the overlap between a pure domestic story and a rate sensitive story. I think the two clear things are that a pure domestic story is less likely to get affected with all the tariff shenanigans that's going on. And the rate sensitive, because I think the situation is now ideal because you have food inflation coming down, you have imported inflation from oil also trending down, and you have a threat of a global slowdown. So I think the situation is right for an RBI rate cut. So rate sensitives plus domestic. So then what do you pick? You pick BFSI, obviously, and you pick consumption, right? Right across from FMCG staples to consumer discretionary to auto to realty and durables. What you want to avoid? Well, I would still say wait and watch on IT. Would still say wait and watch on sectors like defense, which ran up, corrected, but I don't know whether the correction is fully done. So rather wait and watch on those kind of fronts.
Right, wait and watch when it comes to IT and defenses. But yes, a positive outlook coming in for interest rate sensitives, given the fact that tomorrow you have the MPC meet outcome. 10 a.m. is when the RBI governor will be announcing the rate decision. What everyone is penciling in is a 25 basis point rate cut. But there is a section of market that's expecting a deeper rate cut at that. In fact, let me bring on board Gaurav to actually help us understand what are we penciling in when it comes to the MPC meet outcome.
Well, yes. Trump tariff is already causing turbulence in the market, but other than that, specifically in terms of India, we will be watching out on the RBI MPC meetings outcome, because now around 90% of the surveyed economists believe that around 25 basis point of rate cut is what we can see in this meeting as well. With this, the overall repo rate will go to around 6%, and there are two reasons why economists believe that. First is when we talk about inflation, now they believe that inflation is going to ease down. In fact, the inflation, which was as high as more than 6%, is expected to come as low as around 3.6%, which is the lowest in the last 5 years. Other than that, when we talk about IIP data, we are seeing some kind of slowdown because it is expected to grow at around 3.2% in the month of February. Other than that, what is key thing to watch out for is the RBI stance, because currently RBI holds neutral stance, but some economists believe that RBI will go ahead and change their stance to accommodative, while at the same time others believe that it will be really too early to go to and change the stance. And the reason being that it is currently at a trade war situation when we talk talk about tariff which are imposed by Mr. Trump, and that is the reason why they believe that RBI will still remain cautious. Other than that, any kind of commentary from RBI in terms of how the growth is going to be is a key thing to watch out for, because at this moment when we talk about India's growth rate, RBI believes that India can grow at a rate of around 6.7% in terms of GDP in FY26. So any kind of change in estimate is something to be watched out for, and any kind of changes in terms of the stance from RBI, and at the same time any kind of changes in terms of the commentary coming up from the global trades which are happening is a key thing to watch out for. But as of now, around 90% economists believe that we will see another rate cut in this meeting of MPC.
Our base case has been 6.5% for growth for fiscal 26, but we do see downsides of about 30 to 60 basis points to this number. The direct impact for India in terms of the trade exposure is lower when you look at it versus some of the other Asian economies. Inflation, I think, is sort of a good news for India and a silver lining. Inflation numbers have been better than expected in this year or the last three sort of odd readings that we've got. We do think March would also be below 4% and probably the next few months as well. Current number for fiscal 26 on inflation is at 4%, averaging with a good part of CY25 sort of remaining below the 4% mark, driven by easing food inflation. So I think inflation by itself does open up the room for RBI to react and respond. If they were not to do that, then real rates would expand. And then in this context of increasing external risks, of course, that has its own adverse impact on the growth trajectory.
Welcome back. You're watching Closing Trades right here in ET now. If you look at the markets, we are hovering near the day's highest point. A very good recovery and steady recovery at that, given the fact that we've held on to the positive territory and only build on to that through the course of the day, with all the Nifty constituents right now in the positive territory, with Jio Finance being the top gainer on the Nifty with gains of about 5%, followed by Shriram Finance as well as Adani Enterprises. And all the sectoral indices are in the positive territory as well. We have Shivangi Sarda also joining us on the show right now. Good afternoon, Shivangi. And I believe it is relatively been a very good afternoon. Over the last 3 trading sessions, all you could see was red on the screen.
Very good afternoon, Cheryl. So we see that the indices have been, witnessing fresh buying from the last 2 days. In fact, even after the gap down opening yesterday, we saw that there was a lot of strong buying that was seen from the lower levels. People have anticipated a good, drop in accumulating good stock. So overall, the texture of the market looks quite positive, and we are looking at buy on decline strategy as of now. Now, till the time Nifty manages to hold above 22,500 marks, then the next levels that we're looking at is 23,000 levels with a support of 22,222 marks. With, of course, buying seen in a lot of specific pockets like consumption, travel and tourism, some of the financial space stocks as well, which are resilient and strong even in these kind of market. Of course, India VIX has to cool off a little more for, further comfort to the bulls. So till the time it is above 18, some sort of volatile swings and cues will be witnessed in the market.
Okay, interesting. Shivangi, hi, afternoon. So what's your stock bias? Anything that's looking good for a long trade?
Hello, Aisha. So we've seen that, the travel and tourism pack is buzzing, and in that aviation stocks have been on my radar. The crude oil price drop has, been a good plus for Indigo. So this one's on my radar. Now, Indigo has been witnessing consistent buying from the last, 5 months, and any small declines have been utilized for buying. Fresh breakout can be seen over here, and follow-up is also quite strong in this one. So definitely this one's a good buy. Now, I recommend a buy with a target of 5,400 levels and a stop of 5,070 zones. Next up on my radar is, financial space stocks, and these have been doing quite well in such kind of a market scenario as well. So my pick would be on Bajaj Finance. We've seen that the negation of the last 9 trading sessions where it was a little soft and making lower highs, lower bottom, but it has retraced right from its 50 daily exponential moving averages. And the long-term structure looks quite positive as well. And for the trading pick as well, there has been good amount of short covering along with fresh longs being added over here. So recommending a buy here with a target of 9,200 and a stop of 86.80 level.
All right, so those are some of the stocks that actually Shivangi is liking. In fact, Kunal, let me get your also picks then, your closing trade picks for our viewers.
So that will be Reliance Industries, something which I have been bullish on in the morning. Mentioned that the stock has come back into an oversold territory on the charts when it hit that 1150 odd mark, or slightly lower levels than that. And I think on the short term basis, the indicators RSI, MACD, etc. These indicators on the stock indicate that the stock is due for a decent bounce from current levels also. So would maintain that buy on Reliance Industries, expecting the stock to cross 1200 to 1220 mark over the very short term.
All right, so that's a closing pick coming in from Kunal, that is Reliance Industries. Sunil, let me come to you and get your view actually on the entire hospitality, the travel and tourism space, given the fact that now most of them will try and actually look inward, look at domestic oriented counters, and most of them actually cater to the Indian crowd, given the fact that you're seeing a rapid rise in tourism as well.
No, absolutely. And aviation and hotels and those which service that sector, right? The travel operators, all of them are looking very positive to me. Aviation, especially, I think, because Shivangi mentioned this in terms of the oil crude price coming down. I think they are very high operating leverage, and with the kind of oil consumption that they have, it straight away goes into their bottom line. That's one. The second aspect is I think the Mahakumbh was probably a trigger to a lot of religious tourism happening around the domestic front. And I think a lot of temples are getting a makeover, going through their own, refurbishing and all of that, Ujjain temples and other temples. So I think that spark has picked up a lot. So domestic tourism should drive that kind of a flow. And I think hotels are also have built up a lot of capacity anticipatory to all of this. So I see those capacity utilizations running up. So I think these sectors, especially because they're operating leverage and they are sensitive to crude, I think that from that point of view, they are a good buys from a medium-term perspective.
IT, that's the one which is going to be in question, given that you've got TCS's numbers, followed by Infosys, HCL Technologies, and then Coforge. Here's what the street is penciling in for an extremely oversold sector. Yes, you could debate about whether the valuations, even after the fall in some of these names, are looking okay or not. But one is anticipating that a recession in the current setup is going to be very different than 2008 or 2020 crisis. The average estimate, according to Kotak, is that about 22 to 38% is the kind of downside that we could see to the current face value on most of these names. And one is anticipating a 90 to 140 basis point cut in the FY 26 to 27 estimated EBITDA for the tier 1 IT companies. I don't know if we can bring up Kawaljeet Saluja's soundbite or not. He did chat with us earlier today, and he did say that what the current downside is something that the IT sector and the stocks have already priced in. Amidst the given scenario, he feels that TCS is best placed given its least exposure in terms of amidst the IT services basket to US. So TCS is what he's betting on right now. Having said that, a recession, of course, he says, is going to be bad for IT across the board. In fact, let's hear out his bite.
If you are into a recession, then of course you have TCS that will hold up well amongst all these names. Let's say if you're looking at recovery, then you end up with Infosys. So if you have to basically make a split on the sector, there are two cuts that you can adopt. One is a percentage exposure to manufacturing plus retail as a bucket. And that will be the bucket which will be immediately the most impacted. And then you have to put in a cut of discretionary versus non-discretionary spending, or composition of revenues from discretionary versus non-discretionary. So if you take this particular cut, then TCS has the lowest exposure to manufacturing, a relatively high exposure to retail, moderate exposure to, let's say, discretionary. So that seems to be the best positioned. The companies that have a high exposure to manufacturing plus retail combination are Infosys, HCL Tech Mahindra, and LTIMindtree, right? So they would be the most impacted. Now, if you basically delayer it further within this particular segment, Infosys has the highest discretionary exposure as such. So I think this is the framework, to adopt, which is manufacturing plus retail on one axis and discretionary versus non-discretionary. PITC, it's got a direct auto exposure, and auto is in the midst of the storm, so it's vulnerable from that vantage point. Persistent, yeah, actually, their portfolio in the current environment looks all right. Though, of course, the stock is expensive, so which is why we have a sell. So it may meet a lot of the criteria, but if it's expensive, then how do you make money, right? So we are cautious on both.
All right, so that's the take coming in on the IT space. Though Sunil did mention the fact that that would be a space that you would not want to watch out right now, or rather go all in right now and be a little bit cautious on that particular space. But Sunil, you did mention that you are liking interest rate sensitives, and in that, would you also like autos in particular, given the fact what is happening and the global exposure of some of these companies that they have, the auto space?
See, I would say that auto is a mixed bag. Yeah, auto components, because they're export oriented, definitely a challenge, right? In the high end auto, yes, maybe with Tesla coming in, if they're going to allow a lot of that, and if the tariffs on the US automakers are going to come down dramatically from us, then maybe yes, a little bit of a caution. But remember that the 1 lakh crore giveaway is going to come to registry, and auto is one of those which is bought on EMIs. And I think that at the lower end of the curve, see, we've been, all the time talking about a K-shaped recovery in the consumption, and auto is particularly where 7 lakh plus cars only have been selling. But I think this year we should see a broadening of that sale, and you would see entry-level cars also come in because of the tax break, because of the 12 lakh bracket. They are the probably ones who buy those. So I'm not so entirely, disheartened about auto. I think there's a good place to be there and to pick the right stocks. And ultimately, they are rate sensitive. So any rate cut by RBI with liquidity transmission would see EMIs coming down. So I would say that auto as a pack, you've got to be very choosy. But I would not say that I'm negative on auto as a whole. But because it's rate sensitive, I would stay in that. But within rate sensitives, I would place realty a bit higher because it has come through a kind of a slowdown. But any kind of a EMI break and everything boost would help it, because it's a very cyclical, very high leverage sector. So falls are steep and rises also will be steep.
Right. Sunil, so good having you on the show today. Thanks as always for your time. Rupee in the meantime, that's weakened further versus the dollar, and you're seeing a dip of about almost 0.5% trickling in right now. Just want to check in on what the equity markets are up to. While we're holding on to our gains so far, all sectors are in the green. It really is going to be all about, the commentary on tariff that you hear from Trump, and as volatile as it is, so are the equity markets reacting pretty much to every word that he's been speaking right now when it comes to tariffs. So yeah, so far the US futures, they're holding up and are indicating a big upside, but let's see how it actually turns out. For now, you've got the OMC pack looking very good. HPCL is holding up 5.5%. There are names like IRB, Hudco, Policy Bazaar, BSE, unusual list of winners out there from at least the liquid universe. We'll take a very quick break, come right back. We'll continue tracking markets on the other side. Back to closing trades right here on ET Now, and we're holding on to the gains quite nicely. In fact, the US futures, they are holding up as well pretty smartly as we speak right now. A good 200 points up in the green for the Dow futures. So pretty much reversing the course after this, streak of tariff-led losses that the markets have seen in the past two trading sessions. But yeah, you've got the S&P futures as well, holding higher by 1.5% right now, and a 230-point uptick when it comes to the Nasdaq futures as well. Asia closed in with handsome gains. Europe as well is holding on to its gains so far, at least. But what should Indian investors do? We've got Ashi Anand joining in on the show to talk about exactly that. Ashi, hi, afternoon. Good to have you on the show. IT up next, I guess, Ashi. Starting off with TCS, tell me what's the expectation this time from the pure play services business?
Oh, hi. Firstly, thank you so much for having me on the show. In terms of IT services, I think the outlook broadly does remain fairly similar. You have had quite a few years of weak discretionary spends. That is something that we don't really expect to see a substantial change on, especially in the context of Trump tariff and various economic uncertainties driven by what we're seeing coming out of the US. We don't really expect US corporates to release large kind of IT spending budgets. Accordingly, we probably are going to go in for a period of 1 to 2 more quarters before we get clarity on how IT spends are going to emerge. So I think in terms of the IT results which are coming out, we probably broadly kind of expect them to be fairly similar to what you've seen over the past few quarters. And this kind of long pending revival in discretionary demand, I think we are unfortunately going to have to wait for a few more quarters to actually get visibility of that a bit more clearly. We have seen Accenture's results, and those clearly are not very, as in those don't necessarily point to a very strong pickup either.
Good afternoon, Ashi. Thank you so much for joining us. In fact, talking about IT sector, let me take that question to Shivangi and ask her on the charts, how is the IT space looking to you? In fact, the index is under pressure. What exactly is happening globally as well? But what are the charts indicating? Do you think that now that we've seen a rebound, it will sustain for the IT space? And in the IT space, which one do you like?
Pointed out, there has been some sort of a pullback from the lower levels, but overall IT space has been underperforming from the last 4 months. And we are actually forming lower top, lower bottom on the monthly basis for Nifty IT. So overall, we've seen that the strength is clearly lacking over here, and momentum, any if built up, has been faced rejection over here. So be it the heavyweights or the smaller names, all the IT names have been witnessing some sort of a pressure. And I believe there is some sort of global tensions which needs to cool off for, again, IT to pick up strength.
Right, so that's the take coming in on IT space when you talk about them in the charts. In fact, let's talk about the QSR space. You have MK's note that has come out on the QSR space where they believe that the growth slowdown for the Indian QSRs is coming to an end. They see potential for a return of the mid-teen growth in FY26 for QSR beyond the muted Q4 numbers. So you have the Jubilant Foodworks that is buzzing in trade. Westlife Food, Devyani International, they have an ad rating on all of those counters. Not the quick commerce space. Ideally, it would be the QSR space like the Westlife Food as well as Jubilant Foodworks, as well as Sapphire Foods. They have a buy rating. And actually, that gets me to the point. You think now that this time around, it will be the QSR space that will steal the thunder away from the quick commerce space and some of these platform companies, because given the fact that there was a rage for this QSR space and we've all forgotten about them.
Yeah, sure. So that is very interesting. So I think firstly, you just have to look at these very differently, right? Quick commerce is a brand new industry. It is platform business where competitive dynamics, the longer term kind of potential of that industry is still being kind of shaped. You have the potential for a decade of supernormal kind of growth. And how that industry is going to shape up is obviously going to be very different. Coming to kind of QSR. Right, QSR is something which is clearly one of the best plays on discretionary spends. And what you have seen kind of globally is that when an economy crosses a $2,000 per capita overall GDP, you tend to see sharp increases in discretionary spends, as until $2,000, you're pretty much spending on basic survival. There's only that much incremental left over for discretionary. But as incomes keep rising, consumer aspirations keep kind of increasing, and kind of dining out, right, is a very, very clear area of discretionary spends that people tend to allocate more money towards. If we just look at kind of Indian spends on foods, it's about 5% of overall food spends are on kind of restaurants. If you compare this to China and the US, where you're looking at about 50 to 60% of spends on food being outside, it really shows the kind of sheer scope for kind of growth that is available. You have seen clear Indian preference towards willing to kind of experiment with various kind of QSR chains. So I think the longer term growth potential is clearly very attractive. There are strong underlying growth trends. What you have, however, we have been through a 2-year period of kind of relatively weak discretionary spend growth. We need that to really come through. But the longer term outlook for the space definitely is something quite interesting. In terms of stealing the thunder from quick commerce, we don't really think so. Quick commerce, according to us, is a much larger opportunity.
Yeah, sure enough. And, just the churn in the market and some of these oversold names perhaps are seeing a little bit of a bounce coming in. But what's actually bouncing up today is Titan. The total standalone growth in the Q4 that they posted in their updates was a good 25%. The jewelry segment revenue growth of 25% again. And watches, eye care, the emerging business, they've all seen some good growth. In fact, let me take it across to Snehi and get in more details in the quarterly update from Titan.
Well, absolutely. So good set of quarter four updates coming in from Titan, and especially if you compare it with quarter three, very good set of numbers coming in. On a standalone basis, the growth in the quarter has been 25% year on year, and overall FY25 growth for the standalone business has been 21% on a year on year basis. In quarter four, Titan has added 55 stores, which brings the total store to 2,989. Let's talk about the jewelry segment now. Overall growth has been logged in at 25% on a year-on-year basis, and good growth coming in from the jewelry business this time. Growth has been led by gold jewelry as well as gold coins, and elevated gold coins have led to sluggish consumer demand at lower price points, but that's not the case at higher price points because they have seen double-digit growth when it comes to higher ticket sales. So that is looking good when it comes to jewelry sales. Studded jewelry has registered low double-digit value growth. Solitaire segment has flipped around. Remember, in quarter three this was lagging behind, but quarter four numbers for solitaire is looking very good. They witnessed a turnaround with growth in both buyer base as well as value. Overall like-to-like sales for jewelry has grown at 15% year on year. Tanishq has added new stores in Sharjah, Atlanta and Seattle, and 16 new additions when it comes to store additions when it comes to the jewelry segment. Watches, let's talk about watches. Overall growth has been 22% year on year. Titan, Fast Track, Sonata, they've all done very well. Growth of 18% year on year. Helios, Titan World and Fast Track have also seen healthy double-digit growth. Eye care overall growth has been 19%. Healthy double-digit growth coming in for the for Titan Eye Plus as well, especially from its international brands. E-commerce has emerged as the new driver for the sunglasses segment, and Titan Eye Plus numbers are also looking very good. Emerging businesses, when you talk about that, fragrances was up 26%, fashion accessories have done well at 12% growth. Taneira sales continue to be in pressure and they were also down 4% on a year-on-year basis. This is in line with quarter three. Carrot Lane also overall growth has been of 22%. Healthy growth in studded portfolio has been seen. What brokerages are making of this? Macquarie has maintained outperform with a rating target price of 4,000 rupees per share. Morgan Stanley has maintained overweight with a target price of 3,876, and Citi has maintained a neutral with a target price of 3,550 on the back of Titan's quarter four updates.
Okay, that's pretty much a bullish stance coming in on Titan after the quarterly updates. But Ashi, what is your own sense? Jewelry companies are reporting very good numbers in terms of their quarterly update, and would you say that Titan still holds the sort of baton when it comes to jewelry companies? And do you like that space as an investor to begin with?
And we tend to kind of look at kind of value quite closely. And we have been willing to pay up for kind of Titan simply given its kind of very stellar execution over sustained periods of time. And if you are seeing kind of the current quarterly results as well, right, you are seeing that sustain in an overall environment where a lot of sectors and companies are struggling to kind of grow. 25% kind of growth is clearly very attractive. Now, one important element to just kind of understand is that a reasonable amount of this revenue growth that you're seeing, both for Titan and for other jewelry companies, is coming out of pricing growth because of the sharp increases that we have seen in gold prices. That does clearly indicate that kind of underlying volume growth is kind of lower. But even in that context, right, to be able to kind of grow volumes when you have seen sharp inflationary pressure on underlying gold prices itself is kind of quite strong. I think the larger theme that you're kind of seeing play out in jewelry, and you're probably seeing this play out in certain other sectors as well, is not only is there underlying strong kind of demand for that particular segment, but you are seeing a larger shift away from the unorganized towards the organized sector. You're seeing this very clearly in jewelry, you're seeing this in real estate, you're seeing this in a number of other sectors. And I think that is what leads to a fairly kind of favorable outlook. In a kind of a economy where a lot of your FMCG companies very often struggle to even grow revenues at double digits, to have a kind of company as large as Titan, right, being able to quite consistently grow in the mid-20s is quite interesting. And they have kind of indicated that they expect to be able to do so over the longer term. And according to us, that actually allows these current premium valuations to sustain.
Right, that's the take coming in on some of these jewelry counters. But let's talk about what's exactly happening in the market at this point in time. Given the fact that you're seeing a good bounce in BEL, on back of the fact that it has bagged a mega order. You're also having good up move in ONGC, Eicher Motors, Grasim, L&T. Those are some of the counters that are seeing a good up move in trade. Kunal, what's your view, especially on the defense pack, given the fact that it's seen a sizable correction? It's recovered also from those levels. Do you think that now is the time that you can look at some of these counters? Because there's a lot of talks about looking at domestic-oriented companies.
Yeah, I would be, quite bullish on the entire defense pack. And I think what we've seen over the last 9 to 10 months or so, I think from March or April 2024, is that these sectors, they were the first ones to try and go into a corrective wave. There was a point where stocks like Mascot Dock, Cochin Shipyard, I think GREC, etc., they had corrected by 40-50%, some of them even more. And now these stocks have gone through a turnaround of sorts. So from the Jan lows for many of these stocks, we've actually seen a 15 to 20% broader recovery for the most of the defense stocks. And in that space, we've seen two of the key stocks which have started to show signs of strong outperformance. It started with BEL being one of the stronger names, then moved on to Mascot Dock, which I think at one point came very close towards breakout of the previous major highs for itself. And then you've seen HAL also trying to pick up pace and then crossing those levels of 4,000, 4,500. So I believe broadly that's a strong indication that we are looking at a revival and a very strong revival cycle potentially for the entire defense pack.
Right, okay, that's the take coming in on defense. In fact, in the meantime, Cyient, that's one stock which has been in focus. They've launched a semiconductor arm as well. And Anurag Shah, my colleague, caught up with the Executive Vice Chairman and MD at Cyient and also the CEO. Here's a slice of their interaction.
We believe that this market will grow to about a $2 trillion market, just the chips. And of course, the electronics around the chips will go to about a $10-12 trillion market in the next 5 to 7 years. And that's the opportunity that Cyient Semiconductor is trying to address. We will be able to provide custom chips for various applications, and these applications need custom chips because of power reasons, because of cost reasons, because of performance reasons. And that's why we're very excited that we're creating a separate subsidiary to address this very, very large opportunity.
Okay. So the separate subsidiary, from India point of view, how much scope do you see, and means on which segments or which sectors your focus would be initially?
So, I mean, we see a huge opportunity in India. I think the semiconductor market locally is also growing. It's probably go to 300 billion in the next couple of years locally. Well, our sectors are focused on the power semiconductor space. Like Krishna talked about, the semiconductor space today is about 600 billion today, growing to 2 trillion. But the power semiconductor space is probably about 60 billion in the next couple of years. So the goal for us is to focus around power and power efficiencies and saving on that. If you look at that market, really the top areas for us is around industrial, and inside industrial really focused around the AI power for data centers and also the industrial automation. Both require a lot of power, a lot of wastage is happening in power, and to help improve the efficiency of these power chips, we'll focus on some custom silicon like Krishna talked about that will help improve the power efficiency of this.
Okay. So how much capital you will be requiring for this new subsidiary, and how you will be going for some fundraising also, and can we see going ahead the listing of new subsidiary also?
The Cyient board in our previous board meeting has committed to up to $100 million or up to about 900 crores of capital infusion as and when the business will require it. We're still working out the business case and the plans on when we'll require it. The second step is, of course, they've also given us the authorization to look at external capital, and we're working on what is the need and what are the sources of that capital. Now, listing is a little bit premature to talk about, but we'll look at what are the various avenues that we have for capital, because this is a business that has tremendous potential. Of course, will require the capital, but I would say maybe it's a bit premature to talk about listing.
Right, that's the management of Cyient as well as Cyient Semiconductor talking to ET now. But Shivangi, let me come to you and let me get your views actually coming in on the pharma space. How is it looking to you on the charts? And when I talk about pharma, it's not the large cap pharma space. I want to know like the likes of Pyramid Pharma, for the matter of fact, Sovent Pharma. How do these pharma counters look to you on the charts? I believe you'll have to unmute Shivangi.
Higher pharma stocks, and I would, like to extend this to the diagnostic space stock as well, because these are some pockets which are looking very nice. Now, of course, pharma has been highly volatile in the last few sessions, coming from the trade tariff tensions, but the hospital space stocks have been looking quite resilient, and even in such kind of a market scenario, they haven't witnessed such a gap down and gap ups. So, Apollo Hospital is one such stock which is on my radar and has been consolidating at the higher zones on the daily frame as well. Now, the last 2 days have witnessed good volumes on the long side, and we are witnessing fresh buying at these zones. So, definitely, this one's on my radar, shifting focus to the diagnostic space. Now, Apollo Hospital is getting ready for 7,020, 7,050 odd levels with the support of 6,600 levels.
Coming in on the diagnostic names. In the meantime, let's see what, the one island of safety from yesterday is up to. What are the staples and FMCG names doing? And are they still holding out in trade today? Of course, the top gainers today are Titan, like we just discussed. That's the one which has been reacting to its quarterly updates. BEL after those order wins. There's Cipla, there's Bajaj Finance, L&T has bounced back, SBI and Axis are some of the other names. But that's not quite the case with staples. Kunal, what is your sense? Do you think it's only on, savage days like yesterday that you will see that kind of FMCG outperformance that you did?
No, Aisha, I think there's a definite turnaround of sorts for the FMCG pack, because it started off with, I think, just 2 or 3 names, Tata Consumers, Godrej Consumers, that these stocks were starting to show signs of outperformance. Marico, I think, is the third name which started to show signs of outperformance. Most of the other stocks, the likes of Dabur, for example, HUL, they were, going to a phase of correction or, more of a price consolidation. But I think after the strength which has emerged for Tata Consumers, and the other names, Marico as well as Godrej Consumers, I think what we've now seen as a pattern is that the underperforming stocks are making a comeback. So, for example, Dabur, the indicators are hugely oversold, and we expect the stock to get back into a at least a strong short covering mode, if not a very V-shaped kind of a recovery. Even the likes of HUL as well as Britannia, these stocks are now coming back towards the breakout of their minor ranged consolidation over the last 1 to 2 weeks. So that's another sign or an indication that we are looking at a revival for many of these FMCG pack. Yes, of course, the trigger could have been that the market tilts back to the defensive when there is extreme bout of volatility. But what happens is that these are the phases where sectors, they tend to break out, and you see evolving trends which last for weeks and months for these. So I believe that that's the same pattern which you can expect for FMCG.
That's that on FMCG. I also want to see what Shobha, after its Q4 update, is up to. They saw Q4 sales uptick of about almost 22%. That stock is holding up today, but there's Godrej Properties as well, where in Q4 FY25, the booking value grew by about 7% on a year-on-year basis. Ashi, what's the sense on the listed realty plays? Because most of them are a play on premiumization. If the markets do fall a little bit more, there will be that, the wealth effect, so-called, is also going to get impacted. So within the listed realty pool, would you say right now may not be the best time to add, perhaps?
So we like listed real estate, and we like it from a longer term perspective. We see this as one of the more attractive plays over the kind of coming decade. You are basically seeing for listed real estate, the real estate sector itself is coming out of over a decade of kind of virtually nothing happening in terms of launches, price increases, etc. There are very strong underlying demand trends. You are seeing a very clear shift away from the unorganized towards the organized sector. Regulations like RERA have basically helped remove a lot of the problems in the industry, have helped improve kind of buyer confidence. And there's also some amount of price momentum that you're seeing. A combination of all of this basically leads to a fairly favorable kind of longer term outlook. It also is clearly a direct play on discretionary consumption spends, on rising aspirations of urban India. So there are a number of positive longer-term drivers for real estate. It is, however, important to just understand that this is a cyclical kind of industry. If you are going to, we don't expect it. We kind of believe that the current market turbulence is something which is shorter term in nature as you start getting clarity on the growth revival of the Indian economy, as uncertainty around Trump tariffs come away, right, this current volatility that we're seeing in the market should settle and we should move back up. But in case there is a larger kind of a slightly longer, more prolonged weakness in the Indian capital markets, it could lead to some kind of near-term slowdown on real estate. That, however, is not our base case. We kind of expect the current positive momentum to largely sustain. You are seeing some kind of discrepancies across regions. Bangalore over the last year had some issues in terms of approvals that actually led to delays of launches, and which is where a number of Bangalore players have actually been a bit lower as compared to the pre-sale guidances at the start of the year. But if you look at DLF on the other hand, the Gurgaon market continues to be extremely robust. So this is the space overall that we do continue to kind of like. It is just important to understand it will be cyclical. It is high beta. So you kind of make sure it's not a very large part of the portfolio possibly.
All right, so that's the take coming in on the real estate space. Kunal, what's your BTST ideas for our viewers?
So I'll go with two buy calls. The first one is one IEX. That's a chart which is looking attractive in terms of a breakout, potential breakout about the 180 marks. Would look out for 184 as a target. Stop loss at 174. And L&T Finance is the other stock which I believe is showing classical signs of relative strength as well as outperformance, trading above 150 plus levels. Would look out for targets in the range of 158. Stop loss at 150.
Right, so that is the BTST ideas coming from Kunal. Shivangi, do you have more BTST ideas for our viewers?
For quite well, and we have seen good amount of put call ratio that has been improving in this sector. Now, Marico has shown excellent trading volumes and open interest addition in the last 3 trading sessions. With a confirmation of the price as well, and on a weekly basis as well, it has been moving quite well from the last 5 weeks, making higher lows, which indicates that supports are shifting on the higher zones. So definitely a good pick on the radar, quite resilient even in such kind of a high volatility.
Shivangi, if you could just repeat the name once again, we kind of lost the name of the stock.
65.
Shivangi, if you could just reiterate which was the stock that you were talking about in your BTST pick?
I was talking about Marico from the consumption space with a target price of 700 and a stop of 665.
All right, so those are the BTST ideas coming in from my experts. On that note, thank you so much, Rashi, as well as Shivangi and Kunal for being a part of the show, as well as taking us through the sectors that one can watch out for at this point in time. But Aisha, looks like we are ending near the day's highest point, and not been a bad day for the markets.
Not been a bad day at all, not just us. It was pretty much the global tide which took all of us as well up with it. So Asia has had a strong close, Europe is holding out well, and so did we. Managed to hold gap up and managed to stick by with those levels. So closing in with almost a 400-point gain for the Nifty futures. Not quite the 22,700 close, but 22,660 thereabouts is where we're shutting shop for the day, roughly on the Nifty futures. Pretty much all sectors have, participated today. We've got infrastructure, finance, and realty and FMCG, which did take the lead today. And pretty much it was all a sea of green across even the broader health of the market. 210 stocks standing to the advances with a count of just about 12. To the declines when it comes to the F&O universe. The big movers today, Jio Finance held out very well. There was Shriram Finance, BEL, Cipla, Titan, Grasim, Bajaj Finance. These were some of the names which actually held out quite smartly in trade. And within the liquid universe, BSE held up 6.25%. Hudco did very well with a 6% dash. Policy Bazaar held out very smartly. After those excise duty announcements, there was, and of course, the cool off in crude, OMCs held out very smartly. So HPCL had a gain of about 5.5% as well. And then Chola Finance, which also looked good by about almost 5.5% or so. Just few shades of red, and there was Delivery, which fell about almost 8%, IGL, Idea, Siemens, there was Astral, which was down about 1.3%, and within the large caps, I would say it's only Power Grid, which closed in the red, and then Tata Steel and Indocin, which were relative underperformers as opposed to the other large caps.
Yes, absolutely. But you have to take note of the rupee as well in today's trading session, because we saw a 0.5% cut coming in for the rupee, 86.262 the dollar at this mark at 2-week low Apart from that, you also have a lot of counters moving on back of tie-ups. You have BEL that saw a good up move on back of an order win. You have Tata Motors, which has come out with a clarification saying that JLR is evaluating options to address impact of the tariff. They're saying that JLR US shipment paused in April and it did not emanate from any negotiation or an event. So you have Tata Motors that's given a clarification on that particular front today, a positive close coming in for Tata Motors. Apart from that, you have Mazagon Dock that is going to go ahead and pay a dividend of about 3 rupees per share. They've set a record date of April 16th. Take a look at Mazagon Dock, what it is doing in trade today. Ending day higher by about 2%. You have Transformers and Rectifiers that had come out with their Q4 numbers, and that particular counter reacted to those numbers. So Transformers and Rectifiers are the other counter to watch out for in trade today. But all in all, if you look at the markets, yes, we've also seen a bounce back with the rest of the globe. Even the European futures or other European markets are in the positive territory. US futures in the positive territory. Asia is shut shop in the positive territory, and so as our Indian markets. So as we speak, we're shutting shop above that 22,500 mark for the Nifty, holding firmly in the positive territory. But with that, we're totally out of time on this edition of Closing Trades. Goodbye from me, Cheryl, as well as Aisha and the team that put the show together.